Hi everyone, so today I'm going to be covering a new company to be a stock analysis video. It's called Dutch Brothers, so let's get right into it. It's going to be a stock analysis video again, and we are going to take a look on what they actually do, specifically. That, and then the earnings, and then the financials. So just to be specific about it, they are a coffee company. They do have a physical location. It is a retail chain. They sell handcrafted hot and cold beverages, including espresso machines, smoothies, and teas. Great to see. Serves handcrafted beverages, focuses on drive-through experiences. This is kind of like Starbucks, pretty much. I would say it's a Starbucks competitor. They did begin actually in 1990, I believe in the 90s, maybe, but they were franchising in 1999. But they're in a bunch of states, and they are growing. I believe they have somewhere around 1,000 stores or so, 1,000 locations. And they're rapidly growing to compete with Starbucks, really. All right, so the next thing I want to do is cover their earnings because they did come out August 6th of this year, and let's just take a look at it because they've had quite a rally. Dutch Brothers reported total revenue of $415.8 million, a 28% increase year over year. This exceeded analyst estimates of $403 million. The company posted adjusted EPS of 26 cents, which is 44% higher than the estimate of 18 cents. Great. Net income was a 73% increase from the same period in 2024. Great. Adjusted EBITDA grew 36.6%. Great. And same shop sales growth, or same store sales growth, increased by 6.1%, driven by a 3.7% increase in transactions. New shop openings. Dutch Bros opened 31 new shops during the quarter, bringing the total system-wide count to 1,043. And they do have a loyalty program, as all of these retail companies do. Based on the strong Q2 results, this is for the full year. They raised their full year guidance to 1.59 billion to 1.6. Same shop sales growth approximately 4.5%, and adjusted EBITDA to 290 million. So really good overall. They beat on everything. They raised exactly what you want to see. I think if we look at a year out, they're up over 100%, but we're going to take a look at that anyway. But to just continue forward, we're going to first see their free cash flow and see how they're growing. They're past, at least. 2021, negative 38 million, and now 72 million. So they've had quite a ride, and that's where the stock has really ignited. Like, they've gone up into the right significantly. We're going to see that more here, because this is their year-to-date. They're up 25% year-to-date. If we check their 1 year, they're up 109%. So they've really have done quite well for themselves through even the past year. If we check the past 5 years, still decent, 101%, but still that past year, that's when they become free cash flow positive. You'll see in a second. So they've done really well. Now we're going to check Simply Wall Street, and Simply Wall Street's going to say a bit of a different story. They do have, so looking back, again, 2022, negative 126 million, and now positive 72 million. So they finally became free cash flow positive in 2024. I would say, 2024 and 2024. And it looks like there's really not that much growth into the future from these projections. So it's 72 million. It looks like in the next 3 years, it's going to be 84 million. It's not a double or a triple, which I tend to avoid these stocks when they're not significantly and rapidly growing. Now, if we check the financial health of the company, excellent too. No, there is not any negative equity like there once was. It's positive. The cash is more than the debt. It's really good. It looks overall very good, I would say, for the future. There's no complaints here. Now, we're going to check my DCF on it. My DCF is going to say it's 4% undervalued based on historical growth, which I think is the more accurate one because they are growing significantly. If we use Wall Street forecast, Wall Street is going to say it's 59% over, which I don't think it's like that. I think it is undervalued slightly, but not by a lot. Now, if we check Tipranks, which I have to load super fast, it's a strong buy, 14 buys, 2 holds, and it has an average price of about 62 bucks a share. So I think it is a pretty good strong buy as of right now, but they've had quite a rally, and if you want to wait for a bit of a pullback, then wait, but I don't think this is a bad stock. But just keep in mind that it looks like their growth is tempering out a bit. All right, thank you everyone, appreciate it.